Friends, thank you for being here today. What if I told you that while your bank's marketing department is sending you holiday cards and credit card offers, the people who actually regulate those same banks are quietly boarding up the windows? What if the invisible force keeping your deposits safe has just vanished? On January 29th, 2026, something remarkable happened that most Canadians will never hear about. The Office of the Superintendent of Financial Institutions, OSFI, the agency that watches over every major bank in this country, fast-tracked emergency liquidity rules. Not next year, not after consultation. May 1st, 2026. That's 90 days from announcement to enforcement. In the world of banking regulation, where everything moves at the speed of molasses, 90 days might as well be a fire alarm. Let me give you some context on what we're looking at here. The global financial system is sitting on $315 trillion in debt. That's not a typo. $315 trillion. To put that in perspective, if you tried to count to 315 trillion at one number per second, it would take you nearly 10 million years. The entire global economy produces roughly $100 trillion in goods and services annually. We have borrowed more than 3 times what the entire human species can make in a year. This is the scaffolding of the modern financial system, and every support beam is groaning. But here's what makes this moment different. Here's what keeps me up at night. The regulators are moving before the crisis is visible to the public. They are tightening the definition of what counts as liquid at exactly the moment when liquidity is evaporating from the system. When your doctor starts running tests you didn't ask for, that's not routine care, that's concern. OSFI's new Liquidity Adequacy Requirements, the LAR guideline, specifically targets 2 obscure categories that 99% of Canadians have never heard of: retail structured notes and partnership deposits. Now, why would a regulator in the middle of a trade war suddenly decide that the very tools banks use to paper over liquidity stress need to be redefined? Why now? Let me walk you through the architecture of what we're dealing with. Under normal circumstances, a bank's liquidity is simple. You deposit money, the bank keeps some in reserve, the bank lends out the rest, but that's not how modern banking works anymore. Modern banking is a house of cards built on something called rehypothecation, which is a fancy word for using the same asset as collateral multiple times. It's like writing 10 checks against the same $100 bill and praying they don't all get cashed on the same day. The liquidity coverage ratio, the LCR, is the metric that tells you whether a bank can survive a 30-day bank run. 30 days, that's the horizon. OSFI requires Canadian banks to hold high-quality liquid assets equal to their expected cash outflows over that period. But here's the catch. Not everything that looks like cash is actually cash. This is what I call the big secret of the entire system. A government bond that trades every day, that's level 1 liquidity. Cash in the vault, level 1. But a structured product sold to your neighbor as a safe investment, that's not liquid. During a crisis, nobody wants it. It's a 200-page IOU written to itself that only has value if someone else agrees to take it off your hands. And in a liquidity crisis, there are no buyers. Now, here's where it gets interesting. Retail structured notes are exactly the kind of product that appears stable on a spreadsheet but evaporates under stress. These are the investments your bank's wealth management division sells to retirees looking for yield. They promise returns tied to the stock market with downside protection. But when the market freezes, those products don't trade. They sit there like a car with no engine. And if your bank counted them as liquid assets, well, congratulations. You just discovered you're broke. Partnership deposits, what the industry calls brokered deposits, are even more unstable. These are deposits that didn't come from your local branch. They came through third-party brokers who shop for the highest interest rate. The money flows in when rates are good and flows out the moment a better deal appears. It's hot money. It's the financial equivalent of a one-night stand. And OSFI just told the banks, you can't count on this money being there when you need it. Why go through this elaborate charade? The answer is discipline. The regulators are forcing the banks to hold real liquidity, not synthetic liquidity, not structured liquidity, but actual cash and government bonds. Because they see something on the horizon. They see a liquidity event. Now let's talk about timing. OSFI regularly updates these rules. That's true. But they don't fast track them unless something has changed. Liquidity regulation is preemptive. It's the canary in the coal mine. Regulators don't wait for the crisis to be on CNN before they act. They act when the forensic evidence shows up in the data. And right now, the data is screaming. Trade disruptions increase funding volatility. That's a fact. When global supply chains fracture, when tariffs go up, when cross-border capital flows become unpredictable, banks face a problem. They can't fund themselves as easily. The wholesale funding markets, the markets where banks borrow from each other, start to freeze. We saw this in 2008. We saw it again in March 2020 when the Fed had to intervene to keep the entire repo market from imploding. Canada is not immune. The big six banks, Royal, TD, Scotiabank, BMO, CIBC, National, are among the most internationally exposed banks in the world. They have operations in the US, Latin America, the Caribbean, Europe. When liquidity dries up in New York or London, it dries up in Toronto. These banks are connected to the global plumbing. And when the plumbing backs up, everyone drowns. Here's the part that should terrify you. The Bank of Canada is still saying steady as she goes. Interest rates are stable, inflation is moderating, the economy is resilient, but the people who actually see the books, the people at OSFI who get to look inside the balance sheets, are issuing emergency rules. There's a gap between the public narrative and the private reality, and that gap is called risk. This leads us to the system's most crucial secret, which we will explore in the next section. But before we get there, understand this. The financial system is not built on assets. It's built on confidence, and confidence is the most fragile asset in the world. When depositors start to doubt, when institutional investors start to pull back, when the wholesale funding markets start to ask questions, liquidity doesn't just decline, it vaporizes. And once it vaporizes, no amount of emergency regulation can bring it back. The only question is whether you'll still be holding paper when the music stops. Let me show you what's actually happening beneath the surface. Because the real story isn't about banking regulations. It's about what those regulations are designed to prevent. And what they're designed to prevent is already underway. In 1990, Japan made a decision that would reshape the entire global financial architecture. After their real estate bubble collapsed, they dropped interest rates to zero, not low, zero, and they kept them there for decades. This created what traders call the carry trade, the most profitable arbitrage in human history. You borrow yen at 0%, convert it to dollars or euros, buy higher yielding assets, and pocket the difference. Free money, the ultimate money printer. For 30 years, this worked flawlessly. Trillions of dollars flowed through this mechanism. Hedge funds, pension funds, sovereign wealth funds, everyone was doing it. The carry trade became the scaffolding underneath every major asset market. It propped up real estate in Vancouver and Miami. It inflated tech stocks in Silicon Valley. It kept bond yields suppressed across the developed world. And most people had no idea it even existed. But here's the problem with scaffolding. When you remove it, the building doesn't just settle, it collapses. In 2024, Japan started raising rates, not aggressively, just enough to signal that the era of free money was ending. And what happened? The silent giant woke up. The yen started strengthening. And when the yen strengthens, every single carry trade in the world becomes unprofitable. Suddenly you're not making 5% on the arbitrage, you're losing 10% on the currency move. So what do traders do? They unwind, they sell everything: stocks, bonds, real estate, crypto, everything liquidates at once. Now, you might be thinking, that's a Japan problem. What does that have to do with Canadian banks? Everything. Because Canadian banks don't just take deposits and make loans anymore. They are global financial intermediaries. They have derivative books measured in the trillions. They have exposure to every major funding market on earth. And when liquidity drains from the system, it doesn't matter how conservative your lending standards are. What matters is whether you can fund yourself tomorrow morning. This is the structural fault line. The global banking system has become so interconnected that a liquidity shock in Tokyo triggers margin calls in Toronto. The mathematics are inescapable. When volatility spikes, value at risk models force automatic deleveraging. Banks don't choose to sell. They are forced to sell by their own risk models. It's mechanical. It's inevitable. Let me give you a tangible example. In March 2023, Silicon Valley Bank failed in less than 48 hours. Not because of bad loans, not because of fraud, because depositors got nervous and withdrew their money. The bank had plenty of assets. They had treasury bonds, the safest asset in the world. But those bonds had lost value because interest rates had risen. So when depositors demanded cash, SVB had to sell bonds at a loss. And once the market saw them selling at a loss, more depositors panicked. The spiral accelerated. By the time regulators stepped in, it was over. That was one regional bank in California. Now imagine that happening across the entire Canadian banking system simultaneously. Imagine retail depositors, spooked by headlines about trade wars or recession, deciding to move their money to safety. Where does that money go? Into the biggest banks, right? Wrong. In a real liquidity crisis, there is no safe bank. There's only degrees of exposure. And the first institutions to show stress get hit by a run that makes SVB look like a practice drill. This is why OSFI is acting now. They can see the forensic evidence. They can see the structured products that won't trade. They can see the brokered deposits that will vanish overnight. They can see the derivative books that will require massive collateral calls if volatility continues. And they absolutely know that the Canadian banking system is not prepared for what's coming. Now let's talk about the canary in the coal mine, Bitcoin. I know what you're thinking. Bitcoin is a speculative asset. It's got nothing to do with banking. Wrong. Bitcoin is the world's most liquid risk asset. It trades 24/7 globally with no central bank backstop. When institutional liquidity is abundant, Bitcoin goes up. When liquidity drains, Bitcoin crashes. It's a real-time barometer of systemic stress. In early 2025, Bitcoin was trading above $100,000. By late January 2026, it had fallen to $95,000. A 5% decline doesn't sound catastrophic until you realize what it represents. That decline happened while central banks were supposedly maintaining ample liquidity. That decline happened before any official crisis was announced. The market is telling you something. It's telling you that liquidity is already gone. And it's not just Bitcoin. Look at tech stocks. NVIDIA, the darling of the AI boom, has been shedding value for weeks, not because AI is failing, not because demand for chips is declining, because the marginal buyer has disappeared. The leverage funds that were bidding up these stocks are now unwinding positions. They are being forced to sell because their funding has dried up. This is textbook deleveraging. And deleveraging always ends the same way, in liquidation. Here's another piece of forensic evidence that the mainstream financial press won't tell you about. Triricolor. Ever heard of them? Of course not. They were a subprime auto lender operating across multiple states. They collapsed in December 2025 when their credit lines were abruptly frozen. Not reduced, frozen. Their lenders, major banks, decided overnight that they were too risky to fund. Triricolor had no warning. One day they were operational. The next day they were in receivership. Why does that matter? Because Triricolor is a symptom. When credit lines freeze for a mid-tier lender, it means the banks themselves are tightening because they're worried about their own liquidity. It means the wholesale funding markets are starting to seize. It means the plumbing is backing up. And it's not just autos. Look at home builders. Renovo Homes, a mid-sized builder in the Southwest, filed for bankruptcy in early January 2026. Their reason? Unanticipated tightening of credit conditions. Translation: the banks cut them off. Again, not because Renovo was poorly managed, because the banks are hoarding liquidity. They are preparing for a scenario where they can't fund themselves, so they're cutting off everyone else first. This is the no escape encirclement I warned you about. Let's go through the options. Stocks, liquidity is draining. The bid is disappearing. You can sell, but only at a loss. Bonds, yields are spiking as central banks lose control of the long end of the curve. The bond vigilantes are waking up, and when they wake up, they demand higher compensation for risk. Cash, inflation is eroding its purchasing power at 3-4% annually. Real cash, purchasing power, is declining even as nominal cash sits in your account. So where do you go? Gold? Maybe. We'll get to that. But first, understand the trap you're in. You are being forced to choose between assets that are losing value and claims on assets that might not exist when you try to redeem them. This is the money illusion in its purest form. You see a number on your screen and think you're wealthy, but wealth is not a number. Wealth is what you can buy with that number. And right now, that number is becoming increasingly meaningless. The liquidity tide is going out. And as Warren Buffett famously said, only when the tide goes out do you discover who's been swimming naked. Friends, the entire Canadian banking system has been swimming naked. The structured products, the brokered deposits, the derivative books, they were all designed for a world of infinite liquidity. But that world no longer exists. And OSFI knows it. That's why they're moving now, not because the crisis has arrived, because they can see it coming. And when a regulator sees a crisis coming and issues emergency rules with a 90-day implementation window, you need to understand what that signal means. It means the timeline has accelerated. It means the end game is closer than anyone wants to admit. We are facing a convergence. Three distinct forces are hitting at once. First, the structural break in Japan, the unwinding of the carry trade that has propped up asset prices for 3 decades. Second, a domestic liquidity crisis as Canadian banks realize their funding is not as stable as they thought. Third, a sovereign debt spiral as governments realize they can't refinance their obligations without triggering a bond market revolt. This is not a correction. This is not a downturn. This is a mathematical endgame. And the only question that matters is whether you'll be positioned on the right side of it when it happens. Now, we need to talk about something more dangerous than any financial crisis. We need to talk about your mind, because the greatest threat you face right now is not the collapse of the banking system. It's your own refusal to believe it's possible. Human beings are hardwired to believe tomorrow will look like yesterday. This is called normalcy bias, and it's a survival mechanism. For most of human history, it worked. Your village looked the same today as it did last month. The seasons followed predictable patterns. Danger announced itself with clear signals. A predator's growl, smoke on the horizon, a stranger with a weapon. But financial crises don't work that way. They don't announce themselves. They accelerate in silence. The collapse happens in spreadsheets and overnight funding markets that you'll never see. By the time it reaches the evening news, it's already over. The banks have already frozen withdrawals. The bail-ins have already been triggered. Your deposits have already been converted into equity in a failing institution. And you're left standing there holding a statement that says you're a millionaire, wondering why you can't access your own money. This is the tragedy of the modern financial system. It gives you the illusion of wealth while simultaneously ensuring that wealth can vanish the moment you try to use it. You become a millionaire on paper, but poorer at the grocery store. The number goes up, but your purchasing power goes down. And most people never realize the con until it's too late. Let me tell you what happened in Cyprus in 2013. The Cypriot banking system collapsed under the weight of bad Greek debt. The European Union and the IMF arrived with a bailout, but with conditions. Depositors with more than $100,000 would see their deposits bailed in. That's a euphemism. It means the deposits were confiscated and converted into worthless bank shares. People went to bed thinking they had savings. They woke up to find those savings had been stolen by their own government to recapitalize a failed bank. You think that can't happen here? You think Canada is different? Let me remind you of something. In 2013, the Canadian government passed legislation explicitly allowing bail-ins. It's called the Bank Recapitalization Regime. It's on the books, it's legal, and it says that if a systemically important bank fails, the government can convert deposits into equity to keep the bank alive. Your money becomes their collateral, and there's nothing you can do about it. Now, I want to be very clear. I'm not saying this will happen tomorrow. I'm not saying the Canadian banking system is about to collapse next week. What I'm saying is that the architecture for this outcome already exists. The legal framework is in place. The precedent has been set globally. And when liquidity evaporates, not if, but when, this is the tool regulators will reach for. They won't call it theft. They'll call it stability. They'll call it protecting the financial system. They'll call it necessary. But you need to understand what it actually is. It's the transfer of risk from institutions that made bad decisions to individuals who trusted the system. It's privatizing profits and socializing losses. It's the final stage of a Ponzi scheme where the last people holding the bag are retail depositors who thought their money was safe. So what do you do? How do you step out of the line of fire? This is where we get to the binary choice, the choice between fake and real, between claims on assets and actual assets, between paper wealth and tangible value. Do you own assets or do you own claims on assets? That's the question. Your brokerage account shows you own shares in Apple, but do you? No. You own a claim on shares that your broker holds in street name at a clearinghouse. If that clearinghouse fails, your claim evaporates. Your retirement account shows you have a diversified portfolio of ETFs, but an ETF is not an asset. It's a claim on a basket of assets managed by a fund that can suspend redemptions the moment liquidity dries up. This is the great illusion of modern finance. Everything is intermediated. Everything is synthetic. Everything depends on a chain of counterparties honoring their obligations. And in a liquidity crisis, that chain breaks. The first link snaps and the entire structure collapses. Gold, silver, physical metals held outside the banking system. This is not an investment recommendation. This is a statement of mathematical reality. When every other asset is a claim that depends on someone else's solvency, precious metals are the only thing you can hold that has no counterparty risk. You don't need a bank to honor a promise. You don't need a clearinghouse to process a transaction. You don't need a government to guarantee its value. The metal is the value. Now, I can already hear the objections. Gold doesn't pay interest, correct? Neither does cash, but cash loses 3 to 4% of its purchasing power annually to inflation. Gold doesn't. Gold is volatile. Also correct, but volatility is not the same as risk. Gold's volatility is noise. The risk in the banking system is structural collapse. I'll take noise over collapse any day. But the financial system has always survived. Has it? Go ask the people of Weimar Germany if their banking system survived. Go ask the citizens of Zimbabwe if their currency maintained its value. Go ask the depositors in Cyprus if their money was safe. Survival is not guaranteed. It's a probabilistic outcome that depends on trust. And trust, my friends, is evaporating in real time. Here's what I want you to understand. This is not a conspiracy. This is a stated policy. Central banks openly admit they will do whatever it takes to prevent deflation. That means printing money. That means devaluing currency. That means ensuring that your savings lose purchasing power so that debtors can repay their obligations in cheaper dollars. It's not hidden. It's not secret. It's published in their policy statements. They're telling you exactly what they're going to do. The question is whether you're listening. The simple logic of household finance does not apply at the sovereign level. You can't print your way out of debt in your personal life, but governments can, and they will, because the alternative, admitting that the debt is unpayable and allowing defaults, is politically unacceptable. So they will choose inflation. They will choose currency debasement. They will choose to make you poorer rather than admit the system is broken. This is not a collapse in the traditional sense. This is a reset, a reordering of claims. The people holding paper will find that paper is worth less. The people holding real assets will find those assets appreciate in purchasing power. It's a transfer of wealth from those who trusted the system to those who understood the system. And the window for preparation is closing, not closed. Closing. Every day that passes is another day the liquidity drains from the system. Every regulatory announcement like OSFI's emergency LAR is another signal that the end game is accelerating. Every unexpected default by a mid-tier lender or home builder is another crack in the foundation. You don't need to believe me. You don't need to take my word for any of this. Just watch the signals. Watch what the regulators do, not what the central banks say. Watch where the smart money is moving. Watch the forensic evidence in the credit markets. Watch the canaries in the coal mine, Bitcoin, tech stocks, subprime lenders. They're all telling the same story. The tide is going out. And when the tide goes out, you'll discover who prepared and who didn't. You'll discover who owns assets and who owns claims on assets. You'll discover who understood the illusion and who believed in it. History favors the prepared. Not the optimistic, not the trusting, the prepared. The people who looked at the structural fault lines and made the hard decisions before everyone else did. The people who converted paper into metal, claims into ownership, synthetic wealth into real wealth. I'm not telling you to panic. Panic is the enemy of rational action. What I'm telling you is to think clearly, to look at the evidence, to understand the architecture of the system you're living in, and to make decisions based on that understanding rather than on hope. Because hope is not a strategy. Hope is what you're left with when you refuse to prepare. And in a liquidity crisis, hope is the first thing to vaporize. The bond vigilantes are stirring. The silent giant is waking. The paper hangers are unwinding their positions. The scaffolding is creaking. The edifice is crumbling. And the only question that matters is whether you'll still be inside when it collapses or whether you'll have stepped out into the safety of real assets before the doors slam shut. Friends, the emergency rules are being written. The timelines are being accelerated. The regulators are preparing for what they know is coming. The only question is whether you'll prepare too. Thank you for being here. Thank you for listening. And whatever you decide to do with this information, please do not wait for permission from the system to protect yourself, because the system is not designed to protect you. It's designed to protect itself. And when it comes down to choosing between your deposits and their solvency, they've already made their choice. History favors the prepared, and the window for preparation is closing.